Hello everybody. So today, a little bit of a different video, more of a macro video. These tend to not be watched. But the title of the video is, are we losing our minds? Have we been losing our minds since February 2020? How many indiscriminate, widespread sell-off have we gone through since 2020? I think it's definitely more than 30. I haven't counted. It seems that they always happen on a Friday, sometimes on a Monday. And it's always related to Jay Powell. It's always related to the cut, to whether they cut or not. Should you wish for a recession so that they cut more? Should you not wish for a recession so that they don't cut more? It all makes very little sense. I mean, it's like trying to argue with common sense. I mean, this is nonsensical in my view. Of course, this is just my views. This channel. The market sell-off, is mostly driven by risk on and off, and that risk on and off sentiment is mostly driven by what people think the Fed is going to do with the denominator, with how many dollars are out there, i.e. with the interest rates. And Mr. Market, he's a manic depressive guy, as Ben Graham famously says. He can say risk off anytime, and then boom, the whole market sell. Mostly money managers sell, actually, much more than retail. They just sell. The algos kick in, and everybody sells. The options do not help either. And I use the date 2020. Because it's when they really started, messing up with the rates, dropping the rates, injecting money, then removing the money, right? I started my investing career right after the 2008 crash. And so the chief advantage of investing throughout the 2010, throughout that period, is that the markets, in my view, made way more sense. They made way more sense because the interest rates were zero. It was QE to infinity. So we had a policy that was flat. And because that policy was flat, because we never really had to guess where the policy was going to go, then companies could focus on their business. They could focus on disrupting, focus on bringing some of the world's greatest innovations we had in the 2010. We had the Netflix, the Spotifys, the YouTubes, the Amazons, the Nvidias, the Teslas, all of these great companies, their stock really thrived because we didn't have to worry about the money supply going up and down and up and down and up and down. And I happen to believe in QE to infinity. We are going to get back to QE to infinity. This is the beginning of that process. As much as it saddens me to see that the US dollar is just being printed away to infinity, it's also good because we don't have a single person just deciding what's going to happen with the markets based on whether interest rates are high or low. That's the big advantage of a print it all policy or print it away policy. The big advantage is that you don't have to guess the guesses of a committee about interest rates and their own guesses about what it may do to inflation or what it may do to the job market. This is much closer to gambling than investing. We should only worry about the denominator of the business, i.e., are they getting in more sales? Are they getting in more business? Is the product better? And really, these past 4 years, unfortunately, we haven't been able to do that as much. And it's very unfortunate for many reasons. Many companies went out of business because of that, because their stock price was down, because they couldn't raise more money. There's been a lot of issues like that. So this is not really a rant. This is just me saying that this type of market, when you have indiscriminate selling, and granted, today was not the worst day. I'm just using this day as an example. But today was not the worst indiscriminate selling day, but it was really bad still. We had the Japan carry trade. That was even worse than that, but that was just 3 weeks ago. That's the biggest advertisement for DCA, dollar cost averaging. Because that way you don't worry. You never run out of money. You always have a little bit to invest, even though it's not much. You always have a little bit to invest. You do that act, and that act of buying a stock is really a psychological act. It's a feel good act. It's a little similar to shopping. If you if you follow, say, the Chinese apps of shopping, for example, why do people love shopping on them? Because they release a little serotonin. They play with the psychology. I find it comfortable to buy a little stock every day, so I don't feel bad on a day like this being out of money, because I'm not out of money, because I know I have a little money earmarked every day for whatever I find the most compelling on that day. That's my style of investing. And you can do that only if you have a regular income, etc. I just want to point out other important psychological factors, assuming you don't have anything to invest or you're all in already. And I wouldn't blame anybody for being all in, no investment advice, because I believe we're going to have an outstanding fall. I really do, based on the data, right? It's not a blind belief. I think prospect theory is important in this context. So prospect theory, finance theory, Kahneman did a little bit on that one. Anyways, the idea is that losing money is about twice more pain than the pleasure of gaining. So losing $10, making $10, it should be neutral from a psychological standpoint. You shouldn't feel pleasure or pain. It should be neutral. But what we find is that you feel much more pain when you lose than pleasure when you gain. That means to offset the pain of losing $10, you got to make $20 to offset that pain. And so that's very important to realize that the pain of a day like today, the psychological pain of a day like today, you need a day twice as green as today, right? So say Tesla, take Tesla. Tesla's down 7% right now. That means that to cancel out that psychological pain, right? And that depends on each individual. To compensate it, you gotta have a day where Tesla is up 14%, and we have to be aware of these psychological biases. That's why you may remember in this channel I've made a few videos on days like this when the market crashes even more. And what I say is go take a walk in the forest, right? There's a lot of research about just you shut down the brokerage account, you delete the app. Right, and don't do margin. Right, don't try to have a margin call, and then you got your app deleted. No, don't get margin called or anything like that. But just delete the app and go for a walk. And another version of that, which I like very much, is a tin can investing version of you buy a stock and then you ride that stock either to quote unquote the moon or you ride it to zero. And so you don't really worry about following the market every day, because when you buy a stock, you just buy that stock and you set it aside, and then you don't ever look at it again. I think we create a lot of psychological hurt to ourselves by checking the portfolio too often. And me, because of this channel, I end up checking it more than I really used to check it before I started YouTube. I used to check it way less before I started YouTube. I remember 2020 during the crash. It started in February. I didn't even open my brokerage account. I was like, whatever, and I was literally just going on a biking around the city, not really caring. There's an old podcast I used to listen to, and the podcaster used to say, "Enjoy the decline." Like if there is an economic issue, and that was post 2008 with all of the economic woes you used to say, "Enjoy the decline." And I thought that was very very clever. So on a day like this, maybe it's a good time to enjoy it, and remember that whenever you see the account down, it creates psychological pain. We are all human. Psychology drives a lot of investing. I wish it was all rational, but it's not, because if it was all rational, this is what I would be telling you, and this is what I try to do as best as I can. Ben Graham really captures that really well in his book. He says the problem of the investor is that the investor has an itch to do something. And so, of course, I have that itch. That's why I have a YouTube channel where I just talk and rant about stocks. So I have that itch, and many of you probably have that itch to do something. So the way I do it is I invest very small amounts every day, very, very small amounts. So what I do is I have a salary, whatever that month I'm setting aside for investment, and it fluctuates depending on the season. But I say, okay, I'm going to set aside X amount of dollars, right? And then I take that sum and I divide it by 20, roughly by 20. And that way I invest most days. Just a little bit. You divide the sum by 20, right? But you have roughly 20 trading days, actually 22 or 23 depending on the month. But some days, if it's really up, I won't invest or whatever. So I divide it by 20 and then I invest on most days. So today I bought a little bit of SMCI. Finally got into the stock, right? Today I bought HIMS, a little bit of HIMS, right? I bought a little bit of Tesla again today. I bought a little bit of CleanSpark. Teeny tiny amounts, right? No, I mean, that's the way I do it, right? And if you do that, really every day when you invest, it doesn't really change much because, if you've been investing for over a decade like me, many of your investments are in your past, right? I would be in trouble. I would not like, I don't want to say in trouble, I would not like having a lump sum of money to invest. In fact, whenever that happens, I don't like it, right? 9 months ago, I sold the house. I had a lump sum to invest. I did not like that. I don't like it. I prefer to have a steady thing. But it doesn't matter if you like something or you don't. If you don't like something, this is psychology, right? This is not rational stuff. We're talking about psychological stuff. That day is not rational, right? Tesla is not worth 7% less at the end of today versus the day before, right? The value of Tesla is much more theoretical and much greater. In fact, any company, this is true for any company, try any company out here and have a 10-15% owner, try to have them sell 3% of the shares. And you'll see what the value of the stock ends up being. Well, you'll see it's a much lower value, right? From the moment you sell something, you drop the value of that asset. So there's a lot of theoretical aspects that go into this. Anyways, let me move on. And that's not true for the money supply, right? So if you look at disruptive assets, which is what I mostly cover on this channel, Nasdaq, Bitcoin, Tesla, some of it more risky, like the Bitcoin miners. Objectively, they've had nice returns. If you look, this is Nvidia, this is Tesla. Notice I took February 2020, which is really when the interest rate madness started, in my view. I mean, you've had outstanding returns. Of course, who would have known that Nvidia would be dwarfing Tesla in the returns? So perhaps a better way, instead of stock picking, perhaps a better way is to look at more pure play on asset classes. Right? You have Bitcoin, which you're just betting on an asset class. You're not picking anything. It's just the asset class of Bitcoin. You can see the 36%. Average annual returns, and the triple Q, the Nasdaq, almost 18% average annual return. But look at the volatility you've had to withstand, right? The volatility of the Nasdaq, it doesn't really show in blue because I'm charting it with Bitcoin against it. But if you had the Nasdaq against the S&P, the Nasdaq would look much more like a Bitcoin chart, and the S&P would be even flatter. But the flatter you get, the lower the return. It's tough to have return without volatility. Volatility is the price you pay for your returns. And Bitcoin was 36%, over the past 4 years. Well, almost 5 years. Triple Q was 18%. So triple Q returns have been in line, really, with what they've been ever since 2008, 2009. It's been roughly in line. But what has changed is clearly the volatility and the I'm going to call it the psychological annoyance of this back and forth and this back and forth and this back and forth. And for me, it gets amplified because I get the comments, I get my viewers, why is the stock down? Well, it's down because of the reasons that I will conclude this video with, which is we don't live in a hard money standard. We live in a fiat money standard. And these are my views, so I'll share them in a sec. But let's spend a little time. I don't spend a lot of time on this channel explaining why it's called Beat the Denominator. But it is called Beat the Denominator because we are trying to have our assets grow faster than the money stock. This is the money stock in the US financial system. Remember, there are a lot of dollars held outside of the US, and they're much harder to track. But within the US financial system, you can see it's been up only. It's been up only. And the drama, the crisis we've had since late 21, early 22, I mean, it barely made a dent. It barely made a dent. Most people, if they own that stock, and they'd be like, okay, well, it went from 8,000 in 2008 to now, 21,000. It peaked at 21,500, and now it's back at 21,000, and it went down to 20,500, right? Most people would say, it's been flat, I guess, for a couple of years. But don't you worry. The printing is starting again. The rates are getting dropped, and so when the print starts again, You see, the big advantage is that you don't have that volatility in the stock market. Look at how much of a straight line between 2010 and 2020. Look at how much of a straight line the issuance of new dollar was. It was a fully straight line. And so we were much better able to judge stocks based on their fundamentals when the money is issued, the new money is diluted, devalued at the same rate. Right? This is much more unpredictable. And that's why, in my view, we've had such, hard to understand performance in the stock market, despite we see the fundamentals do well. I made a video earlier today about HIMS. The fundamentals have never been better. How many stocks do we see whose fundamentals have never been better? There's many stocks I've covered on the channel where their revenues have 5x, 6x revenue. They weren't profitable. They're profitable today. And 3 years ago, those stocks were trading about twice as high as they are today because of the madness of monetary printing. It's a denominator-dominated story right now. And so, the value of a market of stock fluctuates based on these odds as to what Powell and the board of the Federal Reserve will do. And that's why the CME FedWatch tool is so important. These odds are so important. So now, turns out the recession was not as bad as some feared. I mean, the recession that's coming, the job creation was bad, but some people were kind of perhaps hoping, and it would be wrong to do that, but that's what the Fiat standard does, perhaps quote unquote hoping that it would be worse, because if the jobs report had been even worse than what it already was, maybe we would have had a 71% chance of a 50 cut. And this one is a 71% chance of a 0.25 cut. And some people say, oh, well, really, Powell should really cut 75% or a percent. Others say, well, you would spook the market if you did that. It's all about trying to figure out how the market is going to react. Much less about business and trying to understand how to disrupt, trying to understand the fundamentals, everything we focus on this channel. Trying to understand these price movements like that it makes me dumb. And I think it would make most rational thinkers very dumb, the way it goes up and down, up and down. Was Nvidia worth 30% more just a few weeks ago? Is Blackwell canceled? Is Blackwell not coming? Did a computer not pass the Turing test? Did we not just change the definition of a Turing test and change it again, so that we try to not look at the innovation, the outstanding innovation that AI is? Is Tesla not releasing FSD? If you read books about the early days of flight, this is where it gets very interesting. People, for millennia, they thought flight was not possible. And then flight became a thing, right? And then people dismissed and forgot about flight becoming a thing for like a decade until it became useful in World War I. And then they started taking it seriously again. So do we see the same thing happening for AI? Do we see the same thing happening for genetics? There is this moment where breakthroughs get forgotten, but breakthroughs are real breakthroughs. And if we zoom out from the noise of this monetary printing, from the noise of the fluctuation of the odds of the change in the denominator, if we move out from that noise, we can see those innovations really come through and those businesses really do well. So let me conclude with this, and this is the boring part. You feel free. This is more me speaking like an economist here. You feel free to stop the video here. But I believe in hard money. I'm a hard money advocate. This is why I talk so much about Bitcoin on this channel. This is why I named the channel Beat the Denominator, right? Because really, we wouldn't have to beat the denominator if we were on a hard money. And so, of course, the hard money, I think Bitcoin is the most compelling hard money today. But in the past, obviously, that hard money was gold. Gold, you could only get out of the ground 1 to 3% more gold that you could get out of the ground every year. That was tops. That was the top you could do. And so you had this restraint in the money supply. Today, new dollars over longer, and they're being issued at a rate of about 15% a year. It's also based on the ancient belief that we need to have inflationary money. But we really don't. If you can divide the money to infinity, like Bitcoin or gold, and gold, of course, you had physical limitations to do that. You don't have these limitations with Bitcoin anymore. If you can divide the money to infinity, there's no need for inflationary money. You can just have deflationary money, and that's not a problem. And when people say, for example, oh, well, if we had deflationary money, people wouldn't be able to borrow, to invest, to borrow, to take risks. And I say to that, that's not true. The main difference would be is that people who actually invest in companies would expect a very high return. You know, a mortgage, when you get a mortgage at, say, 5% interest rate, that's brought to you by monetary printing, right? That's sponsored by savers. The savers are getting diluted so that someone can get access to cheap debt. That's the way it works. Really, borrowing money should be a very, very expensive thing, right? I would venture out to say that perhaps only the returns venture capitalists expect are the true returns that one should get from lending money. We've been living in this distorted time. There is a reason why in the 1800s and the 1900s, very few people ever borrowed money to buy anything, right? And you can still go to some parts of Europe where a lot of people just don't borrow money for much, where people just save and wait. Anyways, the cost of money in the fiat system, it dictates investment performance much more than it should. And because you compare it to the cost of money, because we call it the risk-free rate, right? And why does the cost of money, right? So your investment performance is going to be mostly dependent on dilution of the US dollar, especially if you buy the indices, right? If you buy the S&P 500, or if you look at the Case-Shiller index for real estate, it roughly tracks new money supply, right? So it's the cost of money, how cheap money is, will dictate your return in nominal terms. In nominal terms, that's very important to say that, in nominal terms. So in that case, knowing the cost of money is the most important thing, isn't it? It is the most important thing to know the cost of money. And maybe, only maybe, it shouldn't be decided by a committee. Why is it decided by an unelected geriatric committee? Right? You may remember a video I made 2 years ago where I was complaining about the head of the Treasury going on television to announce very important developments with the banking crisis. You remember that? That was 2 years ago now, the banking crisis. She went on television. It was 36% of Americans still have TV, and you have the person going on TV to make the announcement. Like, why don't you go online? People don't have live TV in this country anymore. If you still have TV, you are 1 out of 3. Less, actually, than that. Back then, a year and a half ago, it was 1 out of 3. So anyways, I'm sorry this sounds like a rant. I know, I'm sorry, but it's just the way it is. Also, the benefits of innovation would be visible much quicker, in my view, under a hard money standard. The stock of money would be fixed, so we would only be focusing on business performance. And if we had a hard money standard, I wouldn't have named this channel Beat the Denominator, or the Denominator Growth, right? Which is kind of what I mean by Beat the Denominator. I would have named it like something like Run a Good Business. And don't worry about the dilution part. Just run a good business. And frankly, there would be no talk about Bitcoin. We wouldn't need to talk about any hard asset whatsoever, because the money would be the hard asset against which every single individual business performance is compared. But unfortunately, money is not a hard asset. And so we have to worry about the denominator. You own 1 share of stock, and it is divided by a percentage of how much money exists out there in the world. And that's also why, and I'll conclude with this, that's also why on this channel, people tell me, oh, stocks get diluted, there's dilution, there's stock-based compensation. Why do you use adjusted EBITDA? They add back stock-based compensation. Because the dollar, we compare dollars from today compared to dollars from 10 years ago, and we don't look at the dilution at all. We have some concept about inflation, but the inflation numbers do not reflect at all the real dilution. So you're holding companies to a standard of dilution that is so high, and the dollar is not held to any standard when it comes to the dilution of the dollar. So in most cases, whenever I see a company dilute, they dilute way less than the US dollar dilutes. Right? If a company dilutes shares by 5%, well, guess what? The US dollar dilutes share by 15% on average. And if it happens to be 2020, the US dollar dilutes share by 40%. That's what's going on. So that's my view. Again, I hope I don't lose any subscribers on sharing my view on hard money. I know it's a divisive topic. You don't have to listen to that slide. You can stop here if you are interested in just my psychological views about the market. So anyways, this was not investment advice, no financial advice, no money supply advice, no lifestyle advice, no health advice, no advice, just entertainment. Please like, please subscribe. Thank you for watching. Have a wonderful, wonderful day.